To most people, the stock market looks like pure chaos. And options trading? That is widely viewed as the VIP room of a reckless Wall Street casino. Options are not lottery tickets. They are simple legal contracts. They allow you to control an asset for a fraction of its total price, and your maximum risk is strictly defined before you ever enter the trade. Wall Street buries this reality under dense mathematical jargon, but the mechanics driving these trades are identical to the everyday, real-world transactions you already make. If you understand how a childhood playground works, or the basic logic of buying real estate, you already possess the exact mental framework needed to trade options. Mastering this market is not about predicting the future. It is entirely about recognizing familiar structures and applying them to the numbers in front of you. Let's start with call options. They have a positive correlation with the market. As the stock price goes up, the value of the call option goes up too. Think of it like pushing a child on a swing set. As the market moves forward, the call option swings higher. You can think of a call exactly like making a reservation on a house. If you see a house listed at $300,000, you can pay a small, non-refundable deposit to lock in the right to buy it at that exact price within 60 days. If the house drops in value to $280,000, you are not forced to buy it. You simply walk away, and the only money you lose is that initial limited deposit. Put options behave differently. They have a negative correlation. When the stock price drops, the put option gains value. It acts precisely like a teeter-totter. As the stock sinks down on one side, the value of the put rises up on the other. You buy a put the same way you buy car insurance. You pay a premium to protect your portfolio from a crash, and the policy only pays out when the damage actually occurs. These contracts are not wagers on absolute certainty. They are precise directional instruments designed to isolate specific market movements and protect your capital from downside exposure. There is a hidden variable constantly working against these directional tools. It is the expiration clock, known in trading as time decay, or theta. Every single minute that passes as expiration approaches, the extrinsic value of your option contract melts rapidly away. This creates opposing market incentives. Time decay actively punishes people who buy options, but it automatically generates profit for the traders who sell them. To counteract this decay and mitigate risk, structured traders use a setup called a debit spread. Looking at this visual equation, running a spread is like operating a wholesale lemonade stand. You buy your inventory for $1, and you immediately neutralize your risk by pre-selling it to a lined-up buyer for $1.30. You accept a capped maximum profit. That is the necessary trade-off to ensure your maximum potential loss is strictly defined. Professional traders avoid swinging for home runs. They prefer to execute structured, repeatable wholesale business transactions. Once you understand the mechanical tools of a trade, you have to adopt the psychological mindset required to operate them. Amateurs try to predict exactly what the market will do next. Professionals think in probabilities, trading the market exactly like a weather forecast. This grid of 100 icons shows exactly how that works. A 90% chance of sunshine does not guarantee a dry day today, but if you plan 100 picnics, the math guarantees a dry outcome almost every single time. This mathematical reality is expectancy, the exact advantage casinos rely on. As the grid morphs into a performance graph, you see why casinos never panic over a single lost hand. They win over thousands of interactions, easily absorbing sharp downward dips to a steady profit. A true trading edge is never a hot stock tip. It is the combination of correct structure, positive probability, and relentless repetition. When you understand the mechanics of the playground and the math of the game, trading stops being a gamble. Structure always beats guessing.